So, in October of 1987, Wall Street's smartest computers basically triggered a catastrophic financial collapse.
Oh, absolutely. Black Monday.
Right, Black Monday. And they did it simply because the algorithms assumed there would always be someone on the other end of a phone call.
Yeah, they assumed liquidity was just a given.
Exactly.
Huh.
I mean, the models dictated that if the market dropped, the computers should just systematically sell futures, to protect their portfolios.
Right.
But the models never accounted for a scenario where every single computer tried to sell at the exact same millisecond, and human buyers, they just walked away.
They completely vanished.
Yeah. So today we are tearing apart the source material that actually predicted why those supposedly perfect models were destined to fail, and really why they continue to fail.
It's such a crucial text.
Welcome to the Deep Dive. We are taking you on a journey into the mind of one of modern finance's most provocative thinkers, exploring his raw, unpolished blueprint for surviving chaos, long before he became a household name.
Yeah, we are looking at a 1997 technical textbook. It's titled Dynamic Hedging, Managing Vanilla and Exotic Options, written by Nassim Nicholas Taleb.
A very dense book, by the way.
Oh, incredibly dense. It's a 515-page manual. But at the time of publication, you have to remember, Taleb was an active derivatives trader. He had spent 2 decades in the trenches.
Right, literally in the pits.
Exactly, standing in the screaming physical trading pits of Chicago and then navigating the electronic trading desks of Wall Street.
And we want to be clear to you listening, we are not diving into this massive manual to teach you mathematical formulas.
No, please no.
We are here to extract the underlying mental models from this text. The mission here is to understand the massive, dangerous chasm between neat theoretical models and messy, unpredictable reality.
Because the reaction to this book when it dropped, it was just a fascinating contradiction. Reviewers were completely torn.
Yeah, you had critics who were dismissing it entirely, like calling it formless in structure and horribly written.
Right, some hated it.
But then you have this massive endorsement from someone like Stan Jonas, who was a major managing director at the time. And he proclaimed, "This is not merely the best book on how options trade, it is the only book."
That staggering divide right there.
Yeah.
That tells you everything about the threat this text posed to traditional finance.
It really ruffled feathers.
It did. And to understand why this textbook is so unconventional and why traditional financial theory fails when it hits the real world, you really have to look at the dual identity of the author.
Right, Taleb wasn't just an academic.
Exactly. He started as a pure risk taker. He was an independent pit trader, running his own derivatives firm, literally living and dying by daily market fluctuations.
Skin in the game from day one.
Yes. But mid-career, he transitions. He earns a doctorate. So he becomes this really rare hybrid, the practitioner and the scholar.
He understands the ivory tower mathematics.
Right. But he has the scar tissue of the trading floor.
There's actually a quote on the back cover of the book from mathematician Bruno Dupuyer that perfectly captures that dual identity. And it kind of serves as the central thesis for everything we're going to discuss today.
Oh, I love that quote.
Dupuyer wrote, "If pricing is a science and hedging is an art, Taleb is a virtuoso."
That distinction between pricing and hedging, that is the engine of the entire book.
How so? Break that down for us.
Well, pricing an option, calculating its theoretical value in a vacuum, that can absolutely be reduced to a mathematical science. You just plug in the numbers.
Right, just a spreadsheet exercise.
Exactly. But hedging that option, actively protecting your portfolio against the risks of holding that instrument in the real unpredictable world, that requires intuition.
Because the world isn't a spreadsheet?
Right. It requires judgment and, honestly, a profound skepticism of the very mathematical theories you used to price it in the first place.
And the text actually introduces an archetype to contrast with this virtuoso. It refers to the academic.
Yes, the academic.
The academic is someone who knows the math inside and out, right? They can write these elegant equations on a whiteboard, but they have zero practical experience, and they just place blind faith in those models.
It's all theory to them.
It feels like the difference between a physicist explaining the exact mechanics of a bicycle on a chalkboard versus a bike messenger who actually has to survive rush hour traffic in Manhattan.
That is a perfect analogy. The physicist knows the calculus of balance and momentum.
Right.
But the bike messenger knows about the taxi driver blowing a red light or the hidden pothole covered by a puddle, and the fact that wet brakes just do not respond the way the physics equation assumes they will.
But let me push back on that for a second, because isn't finance at its core fundamentally driven by numbers? I mean, why wouldn't a perfect mathematical model work if you just calculate everything correctly?
Well, the academic operates under that exact assumption, that if the spreadsheet is flawless, the trading outcome will be flawless. But the core philosophy established early in this book is that the greatest risk a trader will ever face comes from that exact mindset.
Ah, so the model itself is the risk.
Exactly. The danger lies in the invisible gap between the model's clean assumptions and the market's dirty reality. Taleb establishes a rigid, unbreakable rule for the virtuoso.
Which is?
If there is a discrepancy between theory and reality, you do not blame the markets for being irrational. You blame the theory for being wrong.
Wow. Okay, so if we agree that static academic models are a trap, we need to understand the actual art the virtuoso uses to survive this chaos.
Right, which brings us to the title of the book.
Yes, dynamic hedging. That gives us the mechanism. But to grasp dynamic hedging, we first need to define the academic's preferred method, right? Static hedging.
Yeah, static hedging is the ultimate set it and forget it mentality.
Like buying house insurance.
Basically, you buy an asset, you purchase an insurance policy or a put option to protect it, and you walk away. You assume your risk is neutralized regardless of what happens next.
But dynamic hedging fundamentally rejects that passivity.
Absolutely. It is the process of continuous risk management. A dynamic hedger is constantly adjusting their position in response to real-time changes. Changes in the asset's price, the market's volatility, the passage of time.
And the reason this continuous adjustment is required introduces one of the most critical concepts in the text, which is path dependence.
Path dependence, yes.
Which is such a counterintuitive concept for anyone outside of quantitative finance. It basically asserts that the route the market takes matters just as much, if not more, than where the market eventually ends up.
Right. The journey matters just as much as the destination.
So, like, if a stock starts the year at $50 and ends the year at $50, a static model looks at the data and concludes that nothing happened. The net change is zero.
But imagine the actual path that stock took. What if, halfway through the year, that $50 stock plummeted to $2 before clawing its way back up?
Right, you'd be panicking.
If you were dynamically hedging, your portfolio went through a violent restructuring. When the stock crashed to $2, your risk metrics screamed at you to adjust. You might have been hit with a margin call.
Forcing you to liquidate other assets just to stay solvent.
Exactly. You sweated blood trying to manage the exposure. The path creates severe real-world friction that static models just completely ignore.
And this concept of continuous messy reality, it leads to one of the most fascinating leaps in the source material. The text actually zooms out from financial trades and introduces the generalized option.
I love this part.
The argument is that options aren't just financial contracts traded on an exchange. They are a fundamental structure that applies to any situation with a convex payoff.
And a convex payoff simply means a scenario where an individual has massive potential upside, but very limited or entirely zero downside.
Right. And the text uses the specific example of a corporate trader's end-of-year bonus.
Yeah, think about it. In a spectacular year, the trader receives a multi-million-dollar payout.
Huge upside.
But if the trader takes catastrophic risks and loses hundreds of millions for the bank, the absolute worst-case scenario for the trader personally is that their bonus is zero. They don't have to write a check to the bank to cover the losses.
Wait, so if a trader gets massive upside without any downside, they're essentially holding a free option on their own company's money. Doesn't that encourage reckless behavior if they don't have to pay for the losses?
Yes. Recognizing that hidden incentive structure is the primary value of understanding the generalized option. This brief observation in the 1997 text is the undeniable seed for Taleb's later culturally ubiquitous concept of skin in the game.
Oh, wow. That makes so much sense.
Yeah, when you learn to spot generalized options in corporate compensation or legal contracts or public policy, you start seeing massive hidden risks everywhere. You realize that systems are constantly endangered by individuals who are incentivized to blow things up simply because they won't suffer the fallout.
So a trader trying to actively manage these risks, to dynamically hedge against a constantly shifting environment, they need instruments to read the terrain in real time.
You need a dashboard.
Right. And the book outlines a mathematical dashboard for this, universally known in finance as the Greeks. These are the risk sensitivities. They translate abstract market movements into actionable data.
We should definitely break down how these actually function mechanically.
Let's do it, starting with delta.
Okay, so delta is the foundational metric. It measures simple price sensitivity. It is the first-order effect. If the underlying stock moves by $1, delta tells you exactly how much the price of your option will move.
So, to ground this in a physical analogy, if I'm driving a car, delta is my speedometer. It tells me my current speed and heading. But a car doesn't just drive in a straight line at a constant speed, which brings us to gamma.
Exactly, gamma. Gamma measures the rate of change of delta. It measures the convexity of your risk. If delta is your speed, gamma is your steering wheel. And specifically, it is how wildly the car swerves when you turn that wheel.
Building on that physical analogy, we then introduce vega.
Vega measures the option's sensitivity to implied volatility. It attempts to price in how wild the future ride is expected to be.
So if gamma is the steering wheel, vega is realizing that the road surface itself is constantly changing.
Yeah. Sometimes it's dry asphalt, and suddenly it is a sheet of black ice. Vega tells you how much more expensive your option becomes just because the market is suddenly terrified of the road conditions.
Then we have theta, which represents time decay. Options are essentially melting ice cubes, right? They have a strict expiration date.
Yep, the clock is always ticking.
So theta tells you exactly how much value your option loses every single day it sits in your portfolio, assuming the stock price doesn't even move.
Exactly. And finally, rho, which measures sensitivity to macro interest rates.
Okay, so we have this dashboard. Delta, gamma, vega, theta, and rho.
But, and this is a big but, the text immediately pivots to explain why this dashboard is incredibly dangerous if you trust it blindly. It introduces the wrinkles of the real market that completely shatter these clean metrics.
Right. To understand these wrinkles, we have to look at the baseline assumption of traditional finance. The standard frameworks, like the famous Gaussian distribution or the Black-Scholes model, they assume that financial markets behave like a normal bell curve.
They assume that volatility is relatively constant.
But the bell curve assumption is fatal. I mean, if you apply a normal bell curve to human heights, the vast majority of people are around 5.5 feet tall, right?
Sure.
You might find someone who is 7 feet tall, but the mathematical probability of meeting a human who is 10 miles tall is virtually zero.
Right. Impossible.
The models treat financial markets the exact same way. They assume a massive 10-mile-tall market crash is mathematically impossible.
Yet anyone trading in the real world knows those massive crashes happen constantly.
All the time.
The book points out that the market itself actually knows the theoretical models are flawed, and it proves it through something called a volatility smile.
A smile?
Yeah. If standard models assume volatility is constant, plotting it on a graph should result in a perfectly flat horizontal line. But if you look at the actual prices traders are willing to pay for options at extreme strike prices, the graph forms a U-shape, a smile.
So if delta is my speed and gamma is how fast my steering wheel reacts, what you're saying about volatility smiles is that the steering wheel suddenly gets hypersensitive just because I'm driving near the edge of a cliff.
That is exactly it.
But let me push back on the math here. If Gaussian models assume a flat line for volatility, and the actual market data clearly shows a curve or a smile, why do people still use the standard models?
Well, the volatility smile is the market collectively screaming that the flat line is a lie. The market is pricing in the reality that extreme price swings. The edges of the smile are far more likely to occur than the academic bell curve suggests.
Those edges.
Right, those extreme, highly improbable events at the edges of the curve are what the text refers to as fat tails. The bell curve assumes the tails taper off into zero probability.
But the real world has fat tails.
Yes, meaning catastrophic outliers are a frequent feature of the system. This brings us to another psychological archetype warned about in the text, the model worshiper.
Ah, the model worshiper.
The model worshiper is a prisoner of elegant math. They see the volatility smiles, they experience the fat tails, but they choose to ignore them because accepting those wrinkles would mean admitting their equations are useless.
Right, their whole worldview would collapse.
Exactly. Hedging dynamically isn't just about zeroing out your delta so your speed is manageable. It requires a constant, exhausting wrestling match with gamma and vega as the market actively bends the rules of physics.
Okay, so we have established that the market bends the rules through fat tails and volatility smiles. But the source text outlines a nightmare scenario where the market doesn't just bend the rules, it ceases to function entirely.
The black hole.
Right. The book calls this phenomenon a liquidity hole. A liquidity hole challenges the most fundamental assumption of any mathematical model, the assumption that you can actually execute your trade.
Every pricing formula assumes continuous liquidity. It assumes that if the math says your option is worth $10, there will be a human being or an institution standing there ready to hand you a $10 bill for it.
Always a buyer.
Right. But a liquidity hole is a moment of severe market trauma where the buyers simply vanish. You realize your dynamic hedge needs urgent adjusting to save your portfolio, but there is absolutely no one to trade with.
Which circles us right back to the 1987 stock market crash we mentioned at the start of the show. The book uses this crash as the ultimate case study for the failure of
It's the
models.
perfect example.
Leading up to 1987, there was this massively popular institutional strategy called portfolio insurance, and it was heavily reliant on dynamic hedging. The mechanics were supposed to be simple. Institutional computers were programmed to systematically sell futures contracts whenever the stock market started to drop.
Right, by selling futures, they theoretically synthesized a put option, protecting their massive stock portfolios from losses.
But the fatal flaw was that the academics who built portfolio insurance assumed the market would absorb that selling smoothly. When the market started to drop in October 1987, the computers executed their programming. They sold.
And that massive wave of selling drove the market price down further. The lower price instantly triggered the computers to sell even more futures to adjust their dynamic hedge.
It created a mechanical feedback loop of doom.
Total doom.
The selling begat more selling, and human buyers looked at the plummeting prices and stepped back from the market entirely. The liquidity just evaporated.
Oof. Got.
The theoretical hedge couldn't be executed at any price, let alone a fair one, and the entire system imploded. It is the equivalent of having a state-of-the-art fire escape that mathematically guarantees your safety, but magically dissolves into thin air the exact second you smell smoke.
That is a terrifying image, but it's true. And that evaporation of the fire escape is compounded by two other phenomena detailed in the text: correlation instability and regime shifts.
What happens with correlation instability?
Under normal conditions, a model worshiper relies on diversification. They hold assets that supposedly move in opposite directions. But during a liquidity hole, correlation becomes unstable. Panic causes everything to crash simultaneously.
Right, to hide.
Exactly. The market behavior undergoes a violent regime shift from predictable calm to total anarchy overnight.
And this reality fuels the author's incredibly fierce critique of a metric called VAR, or value at risk. In the late 1990s, VAR was the absolute gold standard for institutional risk management, wasn't it?
Oh, everybody used it.
It was a single number that claimed to tell a bank its maximum expected loss over a given time frame. But if VAR was so ubiquitous in the 90s, how did a metric that claims to tell you your maximum expected loss become so dangerous?
Value at risk is dangerous precisely because it assumes the worst-case scenario is calculable.
Yeah.
It relies entirely on the normal distribution of the bell curve.
There's that bell curve again.
Right. A VAR model looks at historical data and tells a trading desk, under normal market conditions, there is a 99% probability that the worst you will lose tomorrow is $10 million.
But the textbook just proved that normal market conditions do not matter when your survival is on the line. Fat tails and liquidity holes only happen outside of normal conditions.
Exactly. This represents the core philosophy of the source material coming into sharp focus. In reality, the worst-case scenario is completely unknown and unknowable.
You just can't put a number on it.
You can't. When you hand a model worshiper a VAR number, you give them a false sense of security. They end up taking on significantly more systemic risk because the computer assured them their maximum loss was capped at $10 million.
Wow.
Taleb eventually labels VAR as an outright fraud because it provides intellectual comfort right up until the exact moment a fat tail event wipes out the entire institution.
So if standard vanilla markets are this fraught with hidden traps and liquidity holes, what happens when a trader wades into the most complex, bespoke corners of the financial system?
Oh, it gets even wilder.
A significant portion of this technical manual is dedicated to exotic options. Vanilla options are your standard call and put contracts. Exotic options are highly customized derivatives that banks create for specific corporate clients.
And exotic options introduce extreme path dependence. Take a specific example from the text. A barrier option, sometimes called a knockout option.
How does that work?
Well, a client might buy a knockout call option on a stock. If the stock goes up, they make a massive profit. But the contract includes a barrier. If the stock price dips and touches, say, $40 at any single moment during the life of the contract, the option instantly vanishes.
Just ceases to exist.
It ceases to exist and the client loses everything.
The complexity of valuing something that can instantly vaporize is staggering. So the text outlines a methodology the virtuoso uses to survive trading these instruments, called static option replication.
Yes.
The trader doesn't try to dynamically hedge the unpredictable exotic option directly. Instead, they deconstruct it.
Right. They look at the weird, customized payoff curve of the exotic option, and they go out into the market and buy a specific combination of standard, boring vanilla options at various strike prices.
They build a replica.
Exactly. They bundle these vanilla options together until the combined payoff curve closely mimics the behavior of the exotic option. They replicate the exotic risk using standard tools, and then they dynamically hedge that portfolio of vanilla options, which are far easier to trade and manage if a liquidity hole opens up.
So venturing into exotics and utilizing techniques like static replication requires adopting the final and most important psychological archetype in the book, the survivor.
The survivor.
Standard finance, the academics, and the model worshippers are fundamentally trying to build the absolute fastest, most aerodynamic race car possible to win on a perfectly paved, predictable track. They optimize for maximum profit under normal conditions.
But the survivor, however, assumes the track is covered in landmines.
Right.
They're trying to build tank. The survivor is a tail risk hedger who actively embraces pessimism. They prioritize surviving the off-model risks, the catastrophic events the mathematical equations cannot foresee.
They willingly pay for insurance and protection.
Yes, even when the rest of the market mocks them for overpaying, because they know the fat tail event is inevitable. They sacrifice a tiny bit of optimal profit in exchange for the absolute guarantee that they will not blow up when the regime shifts.
It sounds like they're just focused on staying in the game. That brings us back to the reviewer who captured the legacy of this text perfectly. They wrote, "This is not a book that teaches you how to make money, but a book that teaches you how not to die."
That obsession with survival is the foundational architecture for what Taleb would later develop into the concept of becoming antifragile.
We have covered an immense amount of ground today. We translated the language of the Greeks, understanding how delta, gamma, and vega map the changing physics of risk. We stared down the terrifying mechanics of liquidity holes, where the market just evaporates.
We really did.
And we unpacked why relying on the bell curve in a world defined by fat tails and volatility smiles is a recipe for absolute ruin. You cannot survive as an academic. You have to become a virtuoso who respects the messy, path-dependent reality.
And as we close, I want to leave you with a completely different way to apply the warnings in this text.
Oh, I like where this is going.
We discussed how dangerous it is to rely on static models in finance. But think about the algorithmic models that govern our modern lives today, specifically in the realm of artificial intelligence and machine learning.
Oh, wow.
These algorithms are the new academics. They are trained on vast data sets of human behavior, mapping out normal distributions of how we shop, how we drive, and how we consume information.
Right.
But these models are fundamentally static in their assumptions about human nature. Consider what happens when an unprecedented global event, a societal fat tail, occurs.
Everything changes.
Human behavior undergoes a sudden regime shift. The historical data the algorithm relies on becomes instantly useless. Are we, as a society, operating like model worshippers, blindly trusting the AI's version of value at risk? Or are we building dynamic hedges into our infrastructure, ensuring that when the algorithm hits a liquidity hole of data and fails to predict the chaos, our critical systems don't collapse with it?
That is a brilliant and unsettling reframing of how we interact with technology today. Thank you for joining us on this deep dive. Take this framework with you and examine the neat theoretical models you encounter this week. When you are trying to build something resilient in a chaotic world, the standard academic instruction manual is almost certainly going to catch fire. Stay dynamic,